Okay, welcome everyone to our latest Q&A session in Melbourne. Good start. Last one was in Brisbane. That was the biggest and best we've done, and I think we're going to exceed that tonight. We've got well over 250 registrants online and about 80 people in the room, so welcome everyone. The purpose of these events, as you've heard me say in previous times, it is just a value add. We are not looking to, I'm not going to be up here talking about all our products and all our offers. Elio and the marketing team coined the phrase a couple of years ago, or a few years ago now, about real people. And so it's all about, getting in front of our staff and getting to know our investors and just connecting with them personally. We pride ourselves on the fact that when you call us, you're speaking to a real person every time. Sometimes you may not get hold of us straight away, but you know that you're not going to a call centre off or onshore. And so it's not a sales pitch, and that's one of the key things. Tonight we have a pretty exciting guest speaker in David Koch. As we know, he's best known for gracing our TV screens in the mornings for over 20 years, and also as chairman of Port Adelaide for a bit over 10 years, I think now. But before that, some of you will know, some of you won't. He's a very accomplished financial journalist, editor, and to use a more modern term, I guess, a bit of a content creator in that consumer financial reporting sector. After retiring from our screens, having broadcast over 16,000 hours of live television, over 50,000 interviews, you could forgive him for potentially just retiring and having a quiet life at home, but does remain active in the business world, finance commentary, philanthropy, and of course, as I mentioned, Port Adelaide Football Club, which not many people probably realise is a volunteer job. So high profile, but yeah, you're not getting much reward for that. So welcome, David.
Thanks, Andrew. Yes, as president of an AFL club, it is a voluntary role, and you get no remuneration, but a lot of stick and a lot of attention. I remember any Tigers fans here, Peggy O'Neill, who's when I first started at Port Adelaide, she said the best advice I can give you is that when the team's going well, it's all because of the coach. When they're going badly, it's because of the president. I didn't believe her until we started going badly. And let me tell you, not a true word has been said. But thanks for having me. As Andrew was saying, after 21 years of getting up at 3 o'clock in the morning, I decided it was time to get a bit more flexibility in my life. But I loved every minute of sunrise. But I also have had my own family businesses for about 30 years. So I would finish Sunrise and go to the family business. Well, since leaving Sunrise, I now work business hours, just go straight to the family business. I'm old enough that 2 of my kids actually run the businesses. They dub me the chief bullshitter as my official role, and they say they do all the hard work, and I'm very happy with that. But I've always been a finance nerd. Lived in Melbourne for 12 years, lived in Camberwell when the kids were growing up, and started, if you are old like me, remember Personal Investment magazine back in the 80s and 90s. I started that, launched it in New Zealand and also the UK as well. So I've always been a finance nerd, always loved it. And Sunrise was, if you like, a bit of a hobby that got out of control. They asked me to fill in for 3 months and I lasted 21 years. So I love finance. I love talking about economies. I love talking about investment markets. And that's what the guys have asked me to do today, to give you a bit of an around the grounds of how I see the economy and the business environment over the next 12 months and what it means for you as investors, and then take a look at the share market and the property market as well, and end up with a few sort of investment principles that I think everyone should be following at the moment. And we'll have plenty of time for questions at the end, which is the part I love, because you can either agree with me or disagree. It's great to have a chat. if you've got any specific queries after. So let's take a look at the state of the economy at the moment. Everyone's a bit grumpy at the moment. Everyone's a bit nervous about the economy. Everyone's asset rich and cash poor. Cost of living crisis is hitting people. Increasing interest rates is hitting people as well. So let's start off with the positive. Keep it in perspective. We're one of only 9 countries in the world to have a AAA credit rating from all 3 international credit rating agencies. So yes, we can do things better. Yes, we can improve. But when you step back, you think to yourself, God, you wouldn't want to be in any other country. And I know it's absolutely un-Australian to acknowledge any politician, but we have had a whole series of treasurers, going back to Paul Keating, who have set this economy up pretty well. And yes, we can disagree with certain things the government does, but compared with overseas, we are in really good shape. But the reality is the economy is slowing. If not for 500,000 new customers coming and living in this country in the past 12 months with migration, if you take out the impact of migration in the last 12 months, we are in a per capita recession at the moment. So we've had negative economic growth. And it's only those migration numbers that have been masking that and bumping it up a bit. Even though retail sales had been falling over the last 6 or 8 months, they would have fallen even more without the impact of that migration. Inflation, everyone's focused on inflation. Everyone's paranoid about inflation, fixated on inflation virtually every day. Front page of the newspaper, something about inflation. Yes, it went up after coming out of the pandemic for a whole range of reasons. The old, how many times were we told prices are going up because of supply chain disruption, whatever that meant? Everyone seemed to say there was a supply chain disruption. Inflation did go up. There's a shortage of labour, so wages went up. We also had a federal treasurer that tried to be Oprah and give everyone what they wanted. Yes, you can have a pay rise. Yes, you can have a pay rise. My big query with the treasurer at the moment, I've told him this face to face, is, mate, you just can't be the good cop all the time. You've got to make some hard decisions. You can't leave it all up to the Reserve Bank. You told us to tighten our family budgets, our household budgets, to bring inflation down. And you deliver a budget that is, in the next 12 months, a massive deficit. Now, they do fiddle the figures all the time. And even this week, he's saying last financial year turned into a surplus in the mid-teens. So it will end up about $15 billion surplus for the last financial year, but he's predicting a $20 billion surplus this financial year. So, hey, you've got to tighten the belt as well if we want to fight inflation. So inflation has come down, but not quite to that 2 to 3% target band from the Reserve Bank. And that's that extra mile, if you like. We're halfway through the last quarter of this match against inflation, and it's a tussle to get over the line. And that's why everyone's pretty nervous. We get the June quarter CPI figure on the 31st of July, and then a week later the Reserve Bank meets. So that June figure on the 31st of July, it's the quarterly figure, will be really important on what the Reserve Bank does in August. Will they put up interest rates? As half the analysts, economists think they will, and the other half says they'll just keep them on hold. So why do you put up interest rates? To try and take money out of borrowers' budgets so they can't go and spend and fuel inflation. So I think the June quarter CPI might be a bit better than everyone expected, because you're seeing early signs that construction costs, the increase in construction costs, which has been a major driver of inflation over the last 2 years, 3 years, is starting to slow. And rents, would you believe, are starting to slow as well. In fact, in June, asking rents in Sydney actually didn't just slow, they went backwards in June. So you're starting to see vacancy rates in property, particularly in Sydney and Melbourne, start to eke up a bit, and rental growth starting to soften. Hopefully that will flow through into the inflation figure and start slowing it down and get it within the 2 to 3% range. So I don't sort of, as in terms of an interest rate rise, I don't think that will happen in August, but don't expect any interest rate cuts anytime soon. What you see is what you get, I reckon, until at least halfway through next year. They'll stay at these levels. But there's one big proviso that everyone forgets about. The Reserve Bank's charter is to keep inflation under control and to keep full employment. Now, I don't know about you, but 4% unemployment, I look at that number and then I walk around the street and see all the shops with lease signs out the front of them. I read in the paper all the restaurants and cafes going out of business, and I read that all the major banks are putting through major retrenchments. I read that Telstra is cutting 2,500 staff, and it just doesn't compute. 4% unemployment, and what I see around the market and probably in your businesses. And all the business people that I talk to are saying, things are pretty tough. We've got a hiring freeze. We've been sort of letting excess staff go. History tells us that unemployment is the last economic indicator to turn down when an economy slows. Because once you lose your job, to actually become one of the statistics that make up the unemployment figure, you have to work through any accumulated leave that you're paid when you left your job, or long service leave, and then they have a liquid assets test where the government says, well, if you've got a lot of money in the bank, you've got to go through that first before you actually register for job seeker. So I can't help but think there's this sort of big bulge of people who have been laid off and lost their job, who are just working through the benefits they were paid after being let go, or the cash that they got in their bank before they qualify to be part of that unemployment number. And that's what history tells us happens. But when unemployment starts to turn and go up, it can go up quickly and surprise people. So if that happens, like if we see a really quick increase in unemployment to 4.5%, 5%, I think the Reserve Bank could cut interest rates because of that, rather than inflation, because that's part of their charter. So watch out for that. Unemployment came out again today. That bulge hasn't come through. Unemployment went up from 4 to 4.1%, not much. It was 40,000 new jobs. The market expected only 10,000. Participation rate went up, the number of people who are working, looking to work, and that has an impact as well. But just watch out for that breakout in unemployment over the next couple of months. If that happens, that could spur the interest rate cut. And the other thing is the government is rolling in cash. Everyone talks about our government debt and the billions that we pay in interest, or the billions that we borrowed. Understand that we're a big economy as well. The raw number sounds a bit frightening, but I try and say to people, think of the economy, the total economy as your house. Government debt against the value of the house, the economy, is running something like 45% at the moment, is the gearing on it. And you'd say to yourself, if that's against a house, that's easily manageable. In the United States, their government debt against the value of their economy is 140%. In Germany, it's 100%. You know, Germany, the economic powerhouse of Europe, they have twice the proportion of government debt to the size of their economy as we do. Japan's government debt is 225% of the value of their economy. So that's why I point back to that AAA credit rating. That's what drives that credit rating, why we have it, because our government debt, and we produced a budget surplus last year, unlike many other countries, holds us in good stead. So the economy slowing, but structurally is in reasonably good shape. This is a chart. I'm a big believer in charts because I reckon if you can visualise something, it gives you a bit of a roadmap going forward. This is the Reserve Bank forecast on their cash rate coming down. So they see it peaking at the moment and then starting to gradually come down over the next 12 to 18 months. No sharp decreases at all. But a lot of other countries are starting to, and this is our major trading partners, and you'll see some of them are starting to step down. Canada has started to drop its interest rates. The UK have done it. The Eurozone, Switzerland's doing the same thing. When I grew up, Japan was the economic marvel of the world. Everyone wanted an economy like Japan. Have a look at their interest rate. 0, and it's just popped up to 0.1% because they've been in rolling recessions for about the last 20 years. The Japanese economy has been an absolute court case because they've got an ageing population because they don't have much migration. So that's a big thing about migration is that it reduces the age of your country overall. So you have more workers coming in, more taxpayers, drives the economy. Whereas Japan is more of a closed society and they've really been punished for it. They've had deflation, which is just as dangerous as high inflation for the last 15, 20 years. And now their official interest rates are 0.1% because the economy's starting to turn. Puts it in perspective. Why are interest rates so powerful here in Australia? Because everyone says to me, oh, we're behind the curve with interest rates. We should be putting them up even further and following the United States. Well, the United States is a totally different economy to ours, and they have a totally different interest rate regime. And why interest rates hurt so much here is because we're a country with variable home loans. So when an interest rate increase comes through, it immediately impacts Australian households to do the job. And we're, in terms of fixed rate mortgages, we're one of the lowest in the world. And you look at the United States, that's why increasing interest rates take so long to impact the United States, because a lot of their home loan borrowers are on 20 and 30-year mortgages. They don't give a toss about increased interest rates. They don't benefit from cuts in interest rates either, but they just go on their merry way with their fixed rate mortgage. So that's a really big difference in the power of interest rates. When interest rates rise here in Australia, it affects more people more quickly than virtually any other economy in the world. And since the pandemic, we've had the shortest, sharpest increase in interest rates in our history, and that's what's been hurting. And also what's been hurting is that combination of not only rising repayments, but increasing tax rates and bracket creep. And while the Federal Treasurer has been going, yes, we've got a pay rise for you, and one for you, and one for you, remember, 30% of that pay rise goes into Treasury, into the government coffers through bracket creep, through income tax. So, and it's naive, but politicians sort of speak, they're saying, oh, we're helping you fight inflation because of 4% increase in the minimum wage, and that's almost the same as inflation now of 4%. What they don't say is you're not getting that 4% in your bank account or in your pocket to go and spend at the supermarket. You're really only getting about 3% or 2.5% because 1 to 1.5% of that 4% increase has gone on the government, and that's why the federal budget has been looking so strong, because their tax take is now one of the highest in the world, highest in our history. The Howard government put a ceiling on the percentage that they will take in personal income tax of taxpayers, and last month the federal government breached on the upside that ceiling that was set by Howard. So that's where a lot of the issue is going. So that's why we've got the squeeze. Rising interest rates, rising tax take puts a squeeze on it. And what a lot of people have done is use their savings to be the buffer to this. We've had a cost of living crisis, and so people still want to maintain their lifestyle, and so they've been eating away at their savings. But as you can see, that's about to come to an end, because savings ratios at the moment are one of the lowest ever, from being a record during the pandemic to now a record low. So people are running out of savings reserves. My adult kids go, "Dad, we're finding it really hard to budget, cost of living crisis." And I said, "Do you know what? You've been through the best budgeting process ever. Why don't you go back to it? It's called a lockdown budget. Remember when you didn't go out to dinner or you didn't go to the movies and you couldn't go overseas on the holidays? Well, implement the lockdown budget." You look back and go, "Oh, wasn't life so simple and so easy and all that sort of stuff?" Well, you can do it yourself. You don't need to have it imposed on you by a government or closing the borders. So anyhow, that's being a grumpy old father, but I do have a lot of fun with that. And you young blokes who are here will, yes, say I'm grumpy, because I'll go, when we saved for a house, we would have friends around for dinner rather than go out to a restaurant. We'd have trivia parties and things like that rather than go out to a club and drink. So why don't you do that as well? So that's been again, that's been one of my hobby horses, with my kids saying you don't have a cost of living crisis, you've got a cost of lifestyle crisis. And sometimes you've got to give things up if you want to make a big investment. So savings running out, interest rates up, tax rates up. That's why we're asset rich and cash poor. Thankfully, unemployment has been low, so most people have had a job, and property prices have been going up. So anyone who's had a distressed sale of their property, very few negative equity. So that's a bit of a silver lining to the safety net there. But the state of economy is consumers have gone into their bunker. There's no doubt about that. Consumer sentiment is down. Insolvencies are up towards record levels because of that squeeze. All right, I keep bringing it back to that perspective though. Yes, we can get caught in the weeds and economy slowing, but big picture though is UBS last week released their global wealth index. The average Australian is the second wealthiest in the world, behind Luxembourg. What are they called? Luxembourgians or whatever. I don't know what you call a person from Luxembourg. Anyhow, the average Australian, because of house prices and the financial assets there, the green line, is driven by superannuation. So this national savings scheme that Paul Keating built back in the 90s is really holding us in good stead, and the property prices as well. So as I say, asset rich, which is terrific, cash poor because of the cost of living crisis, and that's the impact at the moment. So economy slowing, yes, there are issues, but compared with the rest of the world, we're in reasonably good shape. interest rates probably staying where they are until the middle of next year, in my opinion. So let's turn to investments now and the state of the market there. And look, we all have our own different investment rules depending on our appetite for risk and all that sort of stuff. But sort of the rules I sort of go by is, it's all about capital preservation. None of us like losing money on our investments. It's all about understanding the turning points of different cycles. Every investment goes in a cycle. It doesn't matter what you're invested in. It's all about building quality in your investment portfolio for the future, and it's all about constantly reviewing it. But there's one very complex, I think, algorithm that answers everyone's question about what's the secret to investing. And for me, it's that. It's not rocket science, is it? It's buying low and selling high. And that's what I mean about understanding cycles and the timing. I think everyone gets really carried away with the complications of investing. It's about cycles, it's about demand and supply when it comes to property. And it's being able to, I think, step back and assess all the data that comes out and then put it in a bit of perspective. And look, in share investing, it's all about investing in cycles. That big drop here, that was the pandemic drop. There, you look at the bumps along the way and then the rebounds. And this week, the All Ordinaries Index up through 8,000 points. It's a record high. The American market has gone through records as well this week. I'll come to that shortly. But also in your superannuation. Since compulsory superannuation started in the 90s, this has been the performance of a balanced fund, the median return of a balanced fund. And since 1992-93, when compulsory super was brought in, the average return has been 7.1%. But you look at the downturns there and the slow ones, and I think that's really instructional on how you should see your investments, because we all panic. We're all human beings. Markets are driven by psychology more than anything else. Not only the performance of your investment, but how you feel about it. And the share market, because it changes constantly on a daily basis, is really in our face. But what this tells us is that if you panicked at each of those downturns, except for the global financial crisis, which were these 2 consecutive years of negative returns, downturns on the share market have always been short and sharp. And if you panic during the downturn, you've usually missed the rebound that follows soon after. And if you just stuck with it, as long as you've got a quality portfolio, as I said, one of the investment rules is invest in quality, it is keeping it there in perspective. Look at, was it 2011, 12, 4% return, followed by 14.7. We started with the pandemic, and then big rebounds after it. So that's the facts. That's economic. Everyone talks about don't panic because you will miss the upturn. When everyone's panicking, like Warren Buffett says, when everyone's panicking, you buy. When everyone's greedy, well, then you look at taking profits. It's all about psychology, and I think that is a great example of it. So let's go through some of the investment markets at the moment. Let's sort of run through property first up, and residential property. You can't generalise about residential property because there are so many different markets around Australia with so many unique circumstances that drive each one. But again, like that buy low, sell high, property is all about demand and supply. It's as simple as that. Strong population growth plus a drop in new homes being constructed equals the current property boom. Now, in perspective, we need to build 250,000 new homes every year just to keep that demand and supply balance equal. All right, 250,000 new homes a year. Last year, only 175,000 were built. Next year, in the next 12 months, only 160,000 are going to be built. So that sort of tells you that supply shortage, that housing crisis, isn't going to be solved anytime soon. Yes, you can cut international students. Yes, you can cut migrants, but they're not cutting enough to do that. So in the next 12 months, 163,000 have been approved. We had 500,000 new migrants in the last 12 months. They say another 300,000 in the next 12 months. So the property squeeze is going to be here for at least another 3 years. That's bad news for renters because that shortage for renters will continue, but great news for property investors because that demand and supply balance will be out of kilter for at least 3 years. And why? Because building approvals are at decade lows. And this is what the government doesn't explain to us. You know, they say there's a property shortage. Let's blame landlords. Landlords are getting greedy. Well, they're not getting greedy at all. It is that they're coping with higher interest rates as well. The property shortage is because you haven't released enough land. Councils take too long to approve building approvals. So get your act together as a government. Don't blame somebody else. And look at this. This is dwelling units approved. And as you can see, basically 15, 20-year lows. Pretty close to that. Now, these guys will tell you usually the time lag between getting approval through council and having it open for somebody to come in is about 3 years, 2 to 3 years, 2 to 3 years. So the shortage is going to last for another 2 or 3 years. There's got to be a big increase in building approvals for it to get through, and largely, you know, you would think it would have to be home units, which are that is the quicker solution because you're building medium to high density. But no one wants them in their backyard. You know, Sydney's got this plan for medium to high density along the railway lines, and they're taking years to get through because local councils won't approve it. So the shortage is going to be around for a while. This is for the month of June, the quarter and the annual for each of the capital cities going forward. You look at key indicators here. Sydney, still the most expensive, starting to slow down a fair bit in terms of growth. Melbourne has slowed down a lot. Brisbane has overtaken Melbourne, which was in about March, as the second most valuable residential property market in Australia. Look at the smaller capital cities of Adelaide and Perth. They're going gangbusters at the moment. Hobart has been dragging the chain a bit as well. So that's what I mean about you can't generalise across a whole bunch of residential markets. You've got to look at it in an instance and individually. One of the things to take notice, this whole demand and supply thing, and I've got a daughter and 3 grandkids in Perth, and my son who lives in Sydney and lives in an inner city suburb called Paddington, which is a really flash, trendy suburb. And he said to me about 4 or 5 years ago, he's married with a young daughter, Dad, we can't afford to buy in Paddington. I went, well, I don't think I can afford to buy in Paddington. Go and buy somewhere where you can afford to live there. Oh, we like living in Paddington there. So I said, look at buying somewhere you can afford, rent it out, and and then you could keep renting in Paddington for a lifestyle situation. So they bought in Brisbane 5 years ago, 4-bedroom house, has just gone gangbusters for them. So they've been a big beneficiary of it. My daughter in Perth just bought their first house there, been renting for 3 years since they moved over there for work. Done really well. Look at that, 23.6% return over the last 12 months, 2% for the month, 6% for the quarter. And I'm going, geez, they've bought at the right time. But then building approvals came out 2 weeks ago, the most recent monthly ones, and building approvals still down in Sydney, still down in Brisbane. Melbourne is up on May last year, up by about 10%. Perth building approvals up 50% on May last year. So I'm thinking, okay, so Perth is really going to plug that stock shortage really quickly if they're starting to, those building approvals are spiking so much. So that's sort of what I mean. You've got to look at each market, but then look at the factors behind it, the lead indicators. Like Sydney, still sort of well down in terms of building approvals, so that squeezes there for a while. Maybe not in Perth because building approvals have shot through the roof if it's consistent and not just a 1 month sort of rogue number which comes out. So I'll look closely at the next month. The other thing to remember from property as well, the gap between units and house values have really changed since the pandemic as well. Unusual. They used to sort of be in tandem. You could invest in units, or you could invest in a dwelling, and houses were usually more expensive, but they would be in tandem, going up with very little gap in terms of growth between them. That has widened with the houses since the pandemic as well. Everyone's sort of been shocked and wanting a bit of space since the pandemic. So that's a real consumer trend going through. So property, solid, has had a great couple of years. It's all about demand and supply, and there doesn't look to be a lot of supply coming on board anytime soon. Let's take a look at the share market now. All-time highs in the US and Australia. And I don't know about you, but I look at a slowing economy. I look at interest rates going up or at high levels. I look at the cost of living crisis. I look at the economy slowing. I look at increased insolvencies in the business community. And the share market going record highs. What the hell is going on? And that's sort of what scares me a little bit at the moment, because the share markets overseas, particularly in the US, have been led by the magnificent 7 tech stocks, Amazon, Apple, Nvidia, Alphabet, which is Google, Meta, which is Facebook, Tesla. They have just shot the lights out to the point, this is the S&P 500 in America over the last 12 months. All of the rest of the sectors are at the bottom there. That blue line is the tech sector. So the tech sector has just had an enormous impact on share market returns in the US. If you've been in tech stocks, you have shot the lights out. If you haven't been in tech stocks, well, you've been a whole lot slower. So it's been a 2-speed share market in the US. Now the share boom has been starting to trickle down into the broader market, particularly in this last week. The broader market in America had their most famous index is the Russell 2000 index. It's a much broader market. In 5 trading sessions this last week has gone up 12%. So after being left behind by the tech stocks for so long, the rest of the market is starting to pick up. There is so much money to be invested in driving the market from ETFs, from pension funds and the whole lot. It looks a bit scary at these levels, but valuations are a bit higher than historic averages, but is at a time where you need to be a little careful. Enjoy it while it keeps going, but be very nimble with your share investments if the market starts to turn, because it's time to understand where we are in the investment cycle. Warren Buffett, the world's best investor, biggest investor, he came up with a Buffett indicator a few years ago to know whether the American share market was overvalued. And it was taking the value of the entire American share market, so the capitalisation of every share listed on the American market, and dividing it by the American GDP, the value of the economy. And this week, that indicator was at 200%. Now that's a record difference. That's a record high of value of American shares compared to the value of the total economy. The last time it was around that level, the American share market dropped 25% in the following 6 months. So be a bit careful with it. I'm an investor in a business streaming network called AusBiz, and I do a share market show on it every day. And so I get to tap into all these share market gurus and analysts. One I love is a guy called Henry Jennings from Marcus Today. And the investment news, they're not saying, mate, I'm worried about the share market. How much are we due for a crash? The bond market is telling me the share market's incredibly overvalued. Bond markets really do have an impact on the share price. What do I do? And he goes, mate, enjoy it while you can. Go along for the ride. It's often the frothy bits at the end of a bull market that give you great gains. So don't be pious and go, oh, well, the market's overvalued, I'm going to sell. Never bet against the market. If the market keeps going up, well, then you keep going along for the ride. But focus on it, because when it turns, then you should turn as well. So I thought that was really good advice. He goes, don't stress, enjoy it. The market's having a party, you're going along for the ride. When the party finishes, be quick enough to get out of it. So I think that's really what wise advice. Three of the Magnificent Seven, just to give you an indication of what they've done. NVIDIA is the yellow. This is what it's done in the last 12 months. Then you've got Microsoft in the blue and Apple with the green. NVIDIA makes the artificial intelligence computer chips for, Intel, a bloke called Moore discovered the silicon chip. The AI is a super version of that chip, and NVIDIA is the one that's producing it. Interestingly, the consequences of that is that they use a hell of a lot of energy, and that could be the ripple effect of AI. Data centers around the world, data centers that drive Amazon, drive your Instagram account, all that sort of stuff, in total use as much electricity as Japan. Data centers have a bigger carbon footprint than the global airline industry. So when people go, oh, why are you flying so much? Because it's bad for the environment. Just go, get off your phone. Cancel your Instagram, cancel your Facebook. Don't buy stuff on Amazon, because in total that is more than the airline industry. And AI computer chips use 10 times more energy than a normal computer chip. So Ireland is limiting the import of NVIDIA's AI chips because they fear it will lead to blackouts, that the Irish electricity grid won't be able to cope with it. So that's a thing in the future. Yes, there's AI is changing our world, but when you're investing, you think to yourself, energy stock could be a beneficiary of this, of all this AI revolution that is sucking so much electricity out of it. Couple of investment themes to look at in the share market. Rising interest rates have been terrible for real estate investment trusts. Awful, because usually REITs have a high level of debt. When the interest rate market turns and rates start to go down, you would expect that REITs would be a beneficiary of that going forward. Now, Macquarie, the analyst at Macquarie last week came out and said their funds are going overweight REITs in anticipation of a cut in interest rates. So, understand the cycles in REITs within share markets as well. The big four banks, everyone has been saying sell the big four banks for 12 months. Every broker, every fund manager has been sell the big four banks. Commonwealth Bank every week just hits a record high. So someone's buying and completely ignoring their broker. But gee, they are incredibly high valuations at the moment. And investing in the share market is not all about buying and selling. It's about sort of buying and averaging down or averaging up. It's about taking profits when stocks or markets are really high. Sort of the ideal is being in a stock that has gone up so much in value that you can take your original investment out of it and everything that's left is a free ride. That's a great way to invest. So it's about banking profits along the way. As I said, focus on energy. Lithium prices down. Uranium has been on a strong run. Oil and gas in demand. Why? Because you've got things like AI and the pressure on our grid at the moment. You've got the introduction of renewables coming in, but we're in that transition period because renewables aren't reliable enough to provide a base load of power when there's extra demand from technology and the like. So what are the consequences? Is it gas? Is it, and I don't know what your ESG filter is. I'm just talking to you about investing. You impose your own ESG filter on everything. But coal stocks at the moment have got a dividend yield of 15% at the moment. Everyone hates coal stocks, but they're actually performing pretty well because governments are saying maybe we've got to extend our coal-fired power stations to provide that base load to give us a bit more time for renewables to transition in properly. So that's the thing to think about. Big seven stocks in America. What are our tech stocks? If you want to ride tech, Technology One is our biggest software business. It provides enterprise software to governments and local councils here and in the UK and America. Brisbane based has done so well. Audinate is another one which is in the video game, and Pro Medicus has been great too. Gold stocks have been a hedge against the economic slowdown and also the Australian dollar. Our gold stocks benefit with the Australian dollar being so low because gold prices are set in US dollars. So in Australian dollars, the gold price is $3,500 an ounce at the moment. And our big gold producers can dig it out of the ground for 800. So I'd like that profit margin in my business at the moment. Problem is some gold companies, when they're rolling in money, sort of don't do the right thing with the money and go out and think of buying some other company, which often doesn't turn out. So, but being good gold companies, they're trending at the moment. And healthcare stocks, CSL, Cochlear, ResMed are the really global market leaders on our share market. Homegrown, CSL is the blood plasma group. I think it's about $310 a share at the moment. Back in, I think it was just like March or April, it was $230. And everyone's going, oh, CSL is such a bad company. So CSL always has pullbacks, but year in, year out is a really good return. And the new breed of pharmaceutical here in Australia, groups like Telix, Neuron and Clarity Pharma have all done really well and have got good products coming through. Just on that energy side of things. This comes from the International Energy Agency, and it is energy supply through to 2050. And you look at coal, the dotted line is the future forecast. Coal coming off a cliff because everyone's got their Paris agreements to meet with carbon outputs. Wind and solar off a low base, big increase. Nuclear, pretty steady. But look at gas. Gas looks as though that's going to be a base load for many countries in terms of energy output. So you look at the big gas suppliers here in Australia, exporters, your Santos's, your Woodsides in oil and gas as well. You just look at trends like that, and then you relate it to good companies that we have here on the market and what it could do for them. So that sort of gives you some of the themes that the experts are telling me, because I talk to them every day in terms of investing in the market. But most importantly, to finish off, it's all about you and how you've got to invest in your knowledge in terms of investment markets. You've got to know more, you've got to update what you know more often, and it will help you control that financial future. Financial security starts with you and your mindset. You can surrender decisions. You can rather delegate decisions in terms of investing. You can never surrender. You've got to take an interest. You've got to learn, and you've got to constantly monitor it. And it can start with challenging your own processes. It can start with challenging your savings and investment habits going forward. Knowledge is power. The best investment, I always say, the best investment you can ever make is in good advice. So look towards that and building an investment team around you, whether it be in property, whether it be in shares or other investments, that you can sort of have some security going forward. And I do a Friday newsletter. If you want to sign up for it, it's free. I just talk about the things I've learned over the week from any experts I've interviewed or come across on the Ausbiz streaming network. I do it on a daily basis, and I just share it with people. So it doesn't cost you anything. We don't do it, but I love what I do. Hopefully that gives you a good idea of the economy and the markets, and happy to take any questions. Oh yes, I've stuck to time. That's pretty good. Good. Yes, sir. The demon supporter. Yep. Okay, all right. Yep. Yeah. And see, the theory goes, and remember, people are still buying banks, and if you'd taken the advice of your broker 9 months ago and sold Commonwealth Bank at $90, you would have missed the last bit to 130. This is what I mean about just don't jump in and out of things, sort of trim, take profits, keep it going, never bet against the market. Sort of they were asking you to bet against the market. If you'd gone with the market and just taken profits along the way, you would have done a whole lot better. Interestingly, when you say the disappearance of cash, there's more cash in circulation today than ever before. Ever before. This is according to the Reserve Bank. It's mainly in 50s and 20s. So the black economy is still going pretty well. $100 notes apparently, this is what people have told me, not that I'm in the black economy, $100 notes attract too much attention, so it's all in 50s. So even though I haven't had cash in my pocket, I don't reckon, for 2 years, and I just tap and go. The thing with banks have become like really big building societies now that they only basically do mortgages. And what the knock on them from analysts has been is that because the economy is slowing, interest rates up, that they'll get more defaults on their home loans, and that will slow their earnings growth. Now, there's no sign of that at the moment, and I think that's largely because property prices still keep going up. So it's not. I don't think it's so much the lack of using cash and tap and go. It's more to do with the strength of their home loan book. Yes, sir. Yep. State levels are still pretty good. Queensland's AA plus, I think. New South Wales is AA plus. I think Victoria's the one below that. I think AA negative. WA is always AA plus because of the mining and exports and things like that. So they're still, by global standards, even states are in reasonable shape. Hard to believe, I know, but yeah. Yeah.
Not a lot of people hold a 50-50 split with ownership side.
Yep.
Is there another instrument in your opinion?
Oh yeah, heaps. Heaps. But it's all federal government stuff. Because they want to be the good cop. And even Michelle Bullock, the boss of the Reserve Bank, the press conference at the end of the last Reserve Bank board meeting, and she's always got to be polite, but in Reserve Bank governor speak, she was quite aggressive, saying, we've only got one lever, and there are a lot of other levers that can be used to fight inflation. Like, energy subsidies, $1,000 in Queensland, plus the federal $350, don't tell me that's not inflationary. Yes, you want to buy votes. Yes, you want to be, popular with everyone, but you can't. If you're doing that, the Reserve Bank has got to keep putting up interest rates. And I challenged the Treasurer on this many times, saying, we're giving everyone a pay rise. The minimum wage goes up, and you go, but you could cause another increase in interest rates that will take that away from them. Oh, well, can't comment about the Reserve Bank and what they're doing because they're independent and the whole thing. And you go, no, but they're reacting to economic data, which you're feeding through this. So, yes, governments hold all of the tools. Reserve Bank has one. Yeah, absolutely. And because of that chart I had before, because you get instant bang for your buck in terms of increasing interest rates. Any other questions? So,
coming back to banks.
Yep.
It was probably about a year ago when Credit Suisse failed, and we had some other regional
Yep.
US banks fall over. There's a lot
Yep.
of chatter about potentially another banking crisis in the US.
Look, you just look at the US on a whole lot of levels and shake your head at the moment, let me tell you. This election, someone said to me, this election at the moment would be like John Howard and Paul Keating running. Same ages. John Howard's 84, same age as Biden. Paul Keating's 80, the same age as Trump. We just wouldn't cop that, would we? And they do. Anyhow, don't get me started on that. Australian banking regulations are really tight, and capitalisation of banks amongst the highest in the world. So no issue here. America has so many little sort of piddly banks, like little community. Anyone who's lived in America, my parents lived there for a long time. They're just weird little banks, sometimes attached to a big office block and stuff like that. So you could get small ones doing that, but they have a very ordered process of when a bank fails, someone just a little bank for someone buys them. Not to name drop, but I was sitting next to the boss of Westpac on a plane earlier in the week, and we were talking about this. And he goes, we have to be capitalised at a high level because there are so few banks here to help each other, and we're so big in the industry, whereas America had lots of really small ones, and now they have a really good way of just buying them out and making sure depositors are safe. So it will create headlines, but not have any major problems. All right, I'm being wound up. Thank you for your time. I am going to come and have a bite to eat with you next door. So if you've got any questions, just sidle up. Happy to chat about it. As you can see, I am a finance nerd. I love talking about it, markets like this, but thank you for having me.